All right. Well, I want to talk about Graincorp because the stock's down about 4.9% right now. The company's signalling a challenging year ahead for 2018, but with what it says is a strong balance sheet. We're joined live now by Graincorp Chief Executive Mark Palmquist from our Sydney CBD studio. Mark, great to have your company on the program today. Thanks for joining us. Obviously, a solid profit this year, but the stock is getting punished today for the guidance for FY18. Tough year ahead. Talk us through, I guess, the next 12 months and what sort of impact it will have on your numbers.
Well, certainly we're looking at a much lower forecast in the crop in Eastern Australia. So it does have a big impact on us on our grain handling business. When we're coming off of a 27 million crop down to 16 million crop, what the independent forecasters are saying, that doesn't leave a large exportable type of crop for us. So our movement will be getting a lot more grains out of other supply chains around the world, and certainly a lot less coming out of Australia.
And grain price is obviously low. I mean, in terms of this supply dynamic, do you expect that to continue, that oversupply dynamic?
It all depends upon what the crop production and weather is around the world. But we've had 3 years of really very good, stable crop production, and we've got near record or record global stocks, depending upon the commodities. So it's going to take a while to work through that. It certainly has had a very negative impact on the price of the commodity itself, but it's also made it a little bit more difficult for Australia to compete in the export markets.
It's tough, though, when you've got these, I guess, things out of your control that you have to deal with. Volatility of production, something that you have to manage that risk. What do you have in place to mitigate these factors that are out of your control but obviously have a very real and material impact on your business?
Yeah, so we've got to be very sensitive inside of our grain handling network that we take down the number of sites that we're running. Most importantly, when they're open up for harvest, we shut them down very quickly. So we just got to be very good cost controls going on so that we can remove those costs. What we don't want to do is change what we're doing executing our strategy. Our balance sheet is very strong. It's giving us the opportunity to keep making capital investments for the future.
Oh, sorry, Mark, it's David here. Just actually on that point, is how do you see the capital investments in the business over the next couple of years?
Yeah, we just came off of a 3-year program, a pretty healthy capital spend, particularly on our processing businesses. So that in itself has come down quite a bit. We've also gone through a portfolio optimization, selling off some of our business and assets. So again, we've got our balance sheet in very good situation. So it gives us the opportunity to look forward and see if there's any acquisitions or any expansions of our present lines of businesses.
Sorry, go ahead, Mark.
Yeah, sorry, Mark. You did a good job, I suppose, in diversifying the earnings stream away from many of those cyclical elements into things like oilseed crushing and malt. What portion of the business does that make up at the moment, and where do you foresee it getting to in the coming years?
Yeah, so on a normalized base, it will make up almost 2/3 of our earnings stream. It's something that we want to continue to grow, but we're pretty comfortable with it being about 2/3 of normalized earnings and 1/3 of it sitting on the grain side. Grain side of the business has always been a good return. It's just that it's very volatile from year to year. So we're not backing away from it, but opportunities for us to have that stabilized earnings is very important for us because we're a commodity-run business.
Foods has obviously been a bit of a disappointing contribution, particularly given health foods and health and food trends are quite favourable at the moment. You're seeing ongoing margin compression in that area. Infant formula customer demand, you mentioned, as being quite unstable. You say you're obviously repositioning this business. How, and I guess what's the timeline for an improvement in margins here?
Yeah, we're going through a major restructuring in that business, and a lot of it is first around taking down costs. The second component is actually going to market in a more efficient manner. And so this is something we're already rolling out, and we look to get full results over the next 2 years. But it's just dealing with a little bit of the margin compression in the industry because there's a lot of capacity. But as important, the investments we made in West Footscray puts us at really the best plant that there is in Australia. And so now we're going to work hard on raising up the utilization of that plant.
Do you expect it to become a bigger part of your business, a bigger proportion of your broader business going forward?
Yeah, it could, but our oilseed, our foods business is primarily a domestic Australian business, and so the market grows as fast as what the population does outside of some of the product mixes. So we're seeing some pretty healthy growth on the dairy blends business, and so we're working on that side of it.
Obviously, the Aussie dollar is something that you watch, and I know in your malts business it's been a bit of a negative impact due to the strength in the Aussie dollar. Is this something you watch closely, and something else, I guess, that's somewhat out of your control?
Yeah, we operate malt houses globally, and so we're impacted by the foreign exchange rates, most notably U.S. dollar, Canadian dollar, British pound. And so when we translate those earnings back into Aussie dollars, it doesn't matter what that exchange is. So it was a negative impact, about $7 million in fiscal 17, but where the Aussie dollar is today and the foreign exchange rates would actually be a positive benefit for us in 18.
And I want to talk quickly energy costs, because obviously it's been a big issue in Australia at the moment. Rising energy costs obviously continuing to be a challenge for long-term sustainability, particularly for your food and malts business. What options are you looking at to mitigate this, and would you like to see more from the Australian government?
Yeah, so it is a big spike for us for fiscal 18. So it's going to cost us an additional $9 million in energy costs for the next year. So two things that we need is one is stabilization, and certainly we'd like to see lower prices, but more certainty on what the cost of energy is, because then that helps us make capital investments that we can work on, trying to reduce our overall cost and exposure to that volatility. So it can be things such as biomass, it can be solar and wind as we look at it. But with the spike where it's gone today, if we see another spike like that going forward in the next 2-3 years, it really is going to make it difficult for us to compete in the export markets, particularly in the malt business.
Okay, I want to ask you quickly about capital management as well, because obviously you've sharply increased your final dividend, fully franked 15 cents a share. That's up quite significantly from a year ago. Is this something that you think is sustainable going forward, particularly given your guidance for next year?
So when we look at 18, obviously earnings will be down. We think the cash flows will be down as well. But again, we've got a very strong balance sheet. So our goal is really try to maintain a high payout ratio, and that's what we'll continue to work on. So we'll just have to see how the cash flows come, but that's our goal.
You said acquisitions could be in the pipeline, just given the fact that you've sold off some non-core businesses, I guess. What are you looking for in terms of acquisitions?
So acquisitions could be add-on in the existing lines that we have, or it could be adjacent lines. So we know what our core strength is. We're very good at managing risk in the commodities business, and we're very good at processing businesses. So we're not going to venture very far when we look at adjacent businesses. It's still going to rely upon our core strengths and any additive impact we have on existing business units.
All right, Mark Palmquist, really appreciate your time on the program today. Thanks for joining us.
Thank you.
Chief Executive and MD there of Graincorp. And we are seeing the stock, as mentioned, down about 4.3%, $8.18. Might bring in my guest host just for a view on this one, post that interview, because obviously it is a tough year ahead. And as we mentioned there, a lot of things out of sort of company control when it comes to sort of grain prices.
Well, that's egg.
But can that, the stock's obviously being sold off quite significantly today,
well,
4.5%.
Really. I mean, given actually we're compared to what the consensus was, it's actually a pretty big miss going forward. So there'll be more downgrades. So I would expect it to be softer over the next sort of week or a few days. Having said that, there's probably been a premium in the share price anyway for potential takeover. So it's always, every now and again there's speculation about it. He does have some options there, though. It's a vastly different business to what it was a few years ago, and from a better point of view.
Well, because they have diversified
and
quite a bit.
Also a balance sheet. They have gone through that. There was a chronic underinvestment in the infrastructure side of the business, and that was probably what turned me off it. But it's sounding like that they've got through a lot of that now and are in better shape. So they've got some sort of flexibility going forward. Yeah,
reducing capex, reducing gearing. I mean, so as you say, flexibility, and for those acquisitions, as you mentioned, Michael, what do you make of it?
Look, it's a very difficult business to get too excited about because it's very difficult to predict future earnings and therefore value, but it's not necessarily the company's fault. I mean, this year was a bumper year in terms of volumes. However, there was so much supply globally that global prices were low.
Exactly.
So it's often just very much out of their control. They have made a number of different steps to diversify their earnings, as I sort of touched on, into those oil seeds and malt, but it takes time for them to build up scale in the overall business as well. So look, for me, it's just to give it a miss, but it's not because the business has done anything wrong. It's just I don't really like the sector overall because it is unpredictable.
Well, this is the thing. I mean, investable, in these sort of ag companies where there are a lot of uncertainties and a lot of ifs sort of going forward, what makes it attractive then to investors, to some investors?
The price relative to sort of what the expectations are. Obviously, this had a takeover proposal on the table, which almost went through. I think it was Archer Daniel Midlands, I think it was, going back a couple of years. That eventually fell through. They eventually cleared their stake. I think they might have had a sort of 15-20% stake. That put a bit of downward pressure on the share price for a while. That was probably your opportunity to buy in, because if you could see and you had the knowledge that the volumes were going to be a bit better this year because of weather patterns, etc., that might be your opportunity. But as a long-term buy and hold, I think it can be quite difficult to sort of pick the cycle.
Yeah, because
I mean, we do that with a lot of different ag stocks, in that you want to buy them when they're out of favour, and then sell them when everything's looking good for that season.
Right.
You know, so it shouldn't actually come as a surprise. We all can see the weather and the forecasts and whatever else, and you just have to make a couple of phone calls to your farming mates, and they know you can say that the 2018 crops this whole year has been a bit of a disaster. So, you know, this is coming through, so we'll see it go out of fashion. You know, a good example of that is Australian ag. You know, it ran up really strongly on cattle prices going up. It was not going to be sustainable because our cattle prices were far ahead of the rest of the world because we were restocking. So, you know, we had all of a sudden we have a downgrade on the basis of the lower downgrade on the value of the stock, the herd. So, you know, the share price gets smashed. But it shouldn't be that much of a surprise. But then you want to be able to look at. So now it's back on my radar for in Australian ag to, you know, because you'd be able to buy
out of favour.
Exactly. You know, so I think whichever ag stock you've got to do, we're very lucky. If you're the actual farmer yourself, you've got to see through it for a year. I think Mark's the CEO, as he talks about, the returns are good over a period of time. But the reality is you can have some good years and some poor years. I mean, we're lucky because we can just buy and sell. We don't have to run the business through the hard years. So, you know, we can pick when to be there.
Do you think that's the way to invest in these sort of stocks, buy and sell, as you said, or would you ever hold it and just kind of ride the waves?
Why?
Exactly, okay. Short term then.
Yeah, no, look, there's certainly some people can make money out of it, that's for sure, because there are big cycles, and that gives the people the opportunity to get in and out.
All right, well, we'll take a break. When we return, Eyes on Asia, Jared Berg from the NAB up next.